Hello friends and welcome to Studyiq. I'm Joy and we are going to discuss a very important concept, that is balance of payments. We will see what is balance of payments, what are the components of balance of payments, and also the previous year prelims questions asked on this topic. So first, coming to balance of payments. What is balance of payments? It is a systematic record of all the economic transactions made between the residents and non-residents of a country for a specific period of time, usually for a year. So it's actually a record. It's a book of accounts, or it's a record of all the transactions that have taken place between the residents of one country and the non-residents of that country. That is, for example, if you take two countries, India and let us take rest of the world. Not a country, but we'll take the rest of the world. Now, when we talk about the balance of payment for India, it is a record of the transactions. That is, the transactions, all the economic transactions that has taken place between India and rest of the world. That is, the residents of India and non-residents belong to rest of the world. So it's a account, or it's a record of all economic transactions between the residents and the non-residents, that is between India and rest of the world. So that is a balance of payment. It gives us an idea regarding how much of economic transactions has taken place between one country and with the rest of the world in a particular period of time, and this particular period of time is usually 1 year. Now coming to the components of balance of payments. These are the components, and we will see these components in detail. First one is the current account. Current account represents, or it deals with all the current account transactions. Then there is a capital account, then errors and omission, overall balance, and reserves. These are the 5 major components of a balance of payments, and within this 5 major components, the most important ones being the current account and the capital account. Apart from current account and capital account, errors and omission, overall balance, and then reserves are also very, very important. So these are the components of a balance of payment. Now we are coming to current account and capital account. As we have already said, current account records all the current account transactions. That is, transactions for a short period of time. Let us see what are the components or the sub-components of a current account. The first one is exports. Exports can be goods exports as well as services exports. Goods and services can be exported. So within current account, the first component is exports, and exports contains the merchandise exports as well as the service exports. Exports are selling goods from one country, that is the domestic territory or the resident country, to the rest of the world, that is exports. Now next component is import, that is the goods that are brought from rest of the world into the domestic country, that is imports. It can be either goods or merchandise, or it can also be services. So again, imports can be goods, services, and goods. Next is trade balance. Trade balance refers to whether it is a surplus trade or a deficit trade. Now, a trade balance is the difference between the exports and the imports. Two major components of a country's trade is export as well as imports. So, trade balance refers to the excess of exports over the imports, or the difference between the exports and imports. Now, if the exports of a country is higher than the imports of a country, we call it as a favorable trade balance. So if the exports are higher than imports, it is called favorable trade balance. And if the imports of a country, or the value of imports, not the quantity but the value, if the value of imports are higher than that of exports, we call it as unfavorable trade balance. So the difference between the export and imports of a country is also known as balance of trade. Trade balance is also known as balance of trade. Balance of trade can be favorable balance of trade, unfavorable balance of trade, or equal. Favorable balance of trade is when the exports are higher than imports. Unfavorable is when the imports are higher than the exports. Then we have net invisibles. We'll come to invisibles in detail. We will see what are the components of invisibles. Next, moving on to capital account. Coming to capital account, the major components. There are 5 major components of capital account. First one is external assistance. That is the assistance given by the rest of the world to our domestic country. Now let us take for example the government of India and rest of the world. External assistance means the assistance given from different other governments or various multilateral institutions to the government of India. The assistance extended to the government from rest of the world. It can be bilateral or it can be multilateral. If it is from one country to other, it is bilateral, and if it's from a multilateral institution to a country, it is known as multilateral. First component of capital account is external assistance. Second one is external commercial borrowing. External commercial borrowing is when the entity, any entity of a domestic country borrows money from outside the country. That is a external commercial borrowing. For example, an Indian corporate or a company, Indian company, if they borrow money from outside the country, then it is called a external commercial borrowing. That is the entity, the corporate or companies in India or in the domestic country borrowing money from rest of the world or from entities outside the country is called external commercial borrowings. Then third, we have short-term debt. Short-term debt refers to debt that is taken for a short period of time. Short-term here refers to 1 to 3 years. 1 to 3 years within the capital account. Now, when we come to capital market and money market, you should not get confused. That's why I'm mentioning about that as well. When we come to financial market can be split into two: money market and capital market. Money market deals with short-term financial instruments, whereas the capital market deals with long-term financial instruments. In case of money market, the financial instruments have a maximum maturity of up to 1 year. So their short-term means 1 year. But here, this is with regard to external sector of the country, and within the external sector, the capital account, within the capital account, short-term debt refers to debt for maximum period of 3 years. Do not get confused with that. Next is banking capital, and fifth is foreign investment. Again, foreign investments can take place in two forms: foreign institutional investment and foreign direct investment. We'll come to the details. Now we are coming to current account in detail. Within the current account, we will see all the components in detail. First is export. Export refers to receipts against export of merchandise goods to other countries. So export means the receipts, what we have received, what the country have received from selling or from the export of merchandise goods and services to the rest of the world or to other countries. So this is actually receipts. So export is a receipt for the domestic country. Next is import. Import is actually payment because we are purchasing goods from rest of the world. So this is payment of import of merchandise goods from other countries. So import is payment, whereas export is receipt. Now coming to trade balance. Trade balance, as we have already said, it is a difference between export and imports. So export minus import will give you trade balance. And if the value of the trade balance is positive, it is called as a favorable balance of trade. And if it is negative, it is called a unfavorable balance of trade. Okay. So if it's positive, it's favorable balance of trade. And if it's negative, it's a unfavorable balance of trade. Next, we have invisibles, that is net invisibles. Net invisibles has 3 subcomponents. One is transfers, second one is services, and the third one is income. So first one is transfer, that is transfer payments. Now what is the meaning of transfer payments? These are grants and gifts without quid pro quo. Transfer payments means the payments received not as a compensation for something but without any service provided. Now for example, if you are getting a gift, it is something that you receive not for any service that you have rendered or not for any work that you have done. It is one-way transaction, and It need not be returned. It is actually something you receive not for any service that you have rendered. That is transfer payments. So it includes grants and gifts which need not be repaid and also which is not a compensation for any of the services that you have rendered. So that is transfers. It is also known as transfer payments. Second one is services. It includes the export and import of services, travel between two countries, transportation, insurance, then financial services, construction services, etc. Then third component is income. Within invisibles, the third component is income. It is transactions regarding income from investments. That is the income that you get from the rest of the world through investments. It can be through dividends, profit and interest earned from loans, etc. So these are the subcomponents within invisibles. Now all these together, that is exports plus imports plus trade balance plus the invisibles, 4 of these components together makes the current account balance. So all together is the current account balance. Next is capital account. Now coming to capital account and different components of capital account, the first one is external assistance. Now external assistance means the assistance given from the rest of the world to the government of the country, to the government of the domestic country. In our case, it is India. So whatever assistance government of India receives from rest of the world is external assistance. It includes transactions of official, that is the government, both bilateral and multilateral transactions. So bilateral transactions include country to country transactions. That is what kind of assistance that one country gets from another country. It's between two countries. And second one is multilateral, which is country and international body loans. Like if IMF or World Bank or AIIB, these are all multilateral institutions. If they provide some assistance to one of the governments, now in our example, it's Indian government to government of India, we call it as multilateral loans. So that is also a part of external assistance. Second component within the capital account is external commercial borrowings. External commercial borrowings also called the ECBs. External commercial borrowings. These are loan transactions by commercial enterprises. So these are the loan transactions by commercial enterprise, that is corporates in a country. If the corporates in a country, now taking the example of India, if any corporate or a company in India is taking some loans or borrows money from rest of the world for some specific purpose, it is known as external commercial borrowing. Next, third component is short-term debt. Short-term debt includes trade credits for a maturity of less than 3 years. We have seen that in case of external sector, short-term refers to a period of less than 3 years. So, short-term debt refers to trade credits for a maturity period of less than 3 years. Here, 3 years is the short term that has been referred to. Next is banking capital. Banking capital has 3 subcomponents. One is foreign assets of commercial banks, second is foreign liabilities of commercial banks, and third is other category. Now, coming to the foreign assets of commercial banks. It includes foreign currency holdings, rupee overdraft to non-resident banks. These are the foreign assets of commercial banks. That is, the commercial banks operating within the country, they must be having some foreign assets. That is the foreign assets of commercial banks. Second is foreign liabilities of commercial banks. It includes NRI deposits. It's a liability. And deposits made by the NRI, non-resident Indians. Non-resident deposits. Then liabilities other than non-resident deposits are a part of liabilities, foreign liabilities of commercial banks. Third is others, which includes the transactions in balance of foreign central banks and international institutions. So that is the third component. Next, coming to the fifth component within the capital account. It is foreign investment, and foreign investment can be in the form of foreign direct investment and foreign portfolio investment. Foreign direct investment is when a foreign entity makes investment in India directly. That is not just in the form of capital, but also shows some business interest in India by investing in infrastructure, manpower, technology, etc. It is called a foreign direct investment. FDI takes place from a foreign country to the host country, to India, not just in the form of capital investment. It is more a kind of business interest. Portfolio investment is when foreign investors invest in Indian companies through the stock market. That is, those investors who are registered with SEBI, Securities and Exchange Board of India, which is a regulator of secondary market in India. So when the investors make investment in the country through stock exchanges in the shares of Indian companies, it is known as portfolio investments. Now coming to current account balance and capital account balance, in short, this will help you understand it and memorize it. So current account balance, the components are export plus import plus trade balance plus invisibles. Now capital account balance, it is external assistance plus external commercial borrowings plus short-term debt plus banking capital plus foreign investments. Altogether makes capital account balance. Now within balance of payment, there are three more things that we have seen in the beginning. First is errors and omission, second is overall balance, and third is reserves. So coming to errors and omission. Errors and omission refers to debit minus credit entries of all the transactions. That is errors and omissions. These are not as important as capital account and current account, but maybe if you get a question in the examination, you can just know what it is. Then second is overall balance, that is current account balance plus the capital account balance will give you the overall balance within the balance of payment. And the reserves. Reserves includes foreign currency assets, that is forex reserves. Then the gold stock of RBI, the special drawing rights holdings with the IMF, SDR of the country with the IMF, then reserve tranche and the SDR. So all these together makes up the reserves, and these are the other components of balance of payment other than capital account and current account. Now we will discuss the previous year questions asked from the topic balance of payment. Both these questions were asked in Prelims 2020, and from the questions you will understand how important is this topic balance of payment. This is actually a assignment for you as well to find out the answers of these questions. With reference to foreign direct investment in India, that is FDI, which one of the following is considered its major characteristics? Now, four options are given. It is the investment through capital instruments, essentially in a listed company. Second, it is largely non-debt creating capital flow. Third, it is the investment which involves debt servicing. It is the investment made by foreign institutional investors in government securities. Four options are given, and it's a very easy question. So, you have to find out the answer. It's a work for you. Second question, if another global financial crisis happens in the near future. So, if there is a global financial crisis coming up in the near future, which of the following actions or policies are most likely to give some immunity to India? So, which of the policies will give immunity to India in case of a recession or a global financial crisis? Not depending on short-term foreign borrowings, opening up to more foreign banks, maintaining full capital account convertibility. So, you have to find out the correct answer, and you have to comment it. Okay, so that is it with regard to balance of payment, which is a very important topic for any competitive examination. I'll see you again with the next topic. Thank you so much for watching, and I wish you all the very best.